I don't need to borrow and I don't have any debt. I just pay cash. So really? You don't have any debt? You don't owe no man nothing? Let's talk. Hello, Money Multipliers. Welcome back to another episode of the Money Multiplier podcast. I'm your host, Hannah Kessler, and we ask ourselves, do our dollars make sense? In this episode, we're going to be talking about the 5 reasons of why we need to be owning whole life insurance. But before I get into the specific topics, I want to make a few announcements of some live events that are coming up. As y'all have heard, myself and Larry Steinhaus, we're going to be hosting a live event in Tampa, Florida, Mastering the Money Game. So it's coming up March 1st and 2nd, and also on February 28th for all of my VIP ticket holders, which is just a very limited select few of you. We're going to be taking a tour around Larry's mobile homes park. And we're going to be getting into the depths of, well, Larry, how did you find this deal? How did you buy it? Did you use other people's money? How are you managing the business that it is now? Or are you just a silent investor in it all? So for my VIP people, we got some awesome plans for you the first day before we get into the 2 days of just in-depth training. And I have some expert industry leaders that are coming out and speaking as well. And also, if you didn't hear too, we do have the 2024 Money Multiplier Live Mastermind recordings for purchase. So for my people who couldn't make it to Nashville this year, you can snag the recordings of the content that we went through in the last 2 days in Nashville. So reach out to me if you don't know how to go and access those podcasts at themoneymultiplier.com, and I will show you how you can go and snag those. And also we will be coming back 2025 for another live Money Multiplier Mastermind event. This year, I want to do it in Denver. All right, so 2025 is going to be Denver, and I wanted to go out more to the West Coast. I hear you people. I know you want us to come and travel to y'all, so I'm making my way out there, and it's going to be a good one. I love Denver. Denver, the mountains, just the scenery, the cool, brisk weather, and, definitely it feels like you can breathe better out there up in the mountains than you can down here at sea level in Florida. So it's going to be a lot of fun, a lot of good times coming up, and mark up your calendar. Start planning now, because you're going to go through, you're going to think that, December is just not that far away, and then January is going to come up. January is like, you're thinking that it's like a decade away, but it's just right around the corner, and then February hits you, then March, and then we're already into past Q1 of 2025. I mean, so many things can happen so fast, so make the plans and just plan for yourself in 2025. So without further ado, let's get into today's episode. Here are 5 reasons why you need to own whole life insurance. Number 1, lifetime coverage of the death benefit. It's not an if I die or pass away, it's a when. And this death benefit is enforced for our entire life until we're age 121. Term life and other permanent products like VULs, IULs, they could totally collapse on themselves, and there's no death benefit that can get paid out to the beneficiaries. I mean, if you go and snag the 2024 Money Multiplier Mastermind recordings, you will hear a live case study from Clay Summers where he shared the story about this woman who, into her latter years, she had this VUL policy and it totally just imploded on itself because of the renewal costs of the insurance, not paying the premiums, the market volatility. So it has that lifetime death benefit coverage, which is guaranteed, and kind of gets me into point number 2, which is there's predictable premiums and it has stability. So I know that no matter what goes on in these outside factors in the outside world, I know what my premiums are, and I got that stability of the guaranteed interest and the guaranteed death benefit that has to be on that policy no matter what. So kind of point number 2. Now, let me also kind of give you a little bit more details there as well. Yes, when it comes to the premiums, you can stop paying premiums in a whole life insurance contract. You don't have to pay them forever and ever. There's ways that you could change it to a reduced paid up and not have to pay any more of the premiums, and then just have the policy run on an autopilot. So that is always an option. But as we know, and kind of leading into my point 3 of the benefits to owning a whole life insurance policy is that we have cash accumulation and access to the capital. When I get into those later years of the maturity of it, and I'm putting in a premium dollar and I'm getting back $2 for that $1 I put in, I'm never going to want to stop paying these premiums because of the growth and the uninterrupted compounding and the time value that policy is getting me in those later and later years. So with that cash accumulation that I get, that's guaranteed. Yes, and I also get my dividends. I understand that dividends are not guaranteed, but point number 4, the dividends that I do receive in the policy. Now, specifically, this is for participating is what the, what do I want to call them? Like the average people. I can't think of it right now, but the people, the textbook people, right? They like to call it participating policies. Participating policies just mean that you have a policy with a mutually owned insurance company, and what's mutual about it is that you are an owner of the company because you're a policy owner, and then you share in those profits, and those profits that the insurance company produce, that's what comes back to us in the form of that dividend. And all of this cash accumulation and the dividends that we receive in the policy, point number 5, this is tax-free, and I'll even add number 6, which is the protection behind it as well. So all of the growth that I get is tax-free to me. The dividends that I receive back are tax-free, payable to me as well. And then it is protected because in the event that something bad were to happen, nobody can come after the money that's sitting inside of my policies. No judgments, liens, or lawsuits. No one has access to the money that's sitting inside of my policies. I can never lose this appreciating asset. So just some few basic points of, why we should be owning this, because here is a big problem that the infinite banking concept solves that not a lot of people like to recognize, but as us, the American population, we are severely undercapitalized. We do not know the meaning of savings, and when we do save our dollars, we're doing it in the wrong environments. We're leaving it exposed to others, to risk, to fees, to taxes. Maybe we're locking it up in a 401k, and that's all that the policy is just my warehouse, my storage of my capital to keep it liquid, allow me to still have access to it, to protect it, and then also build with the compounding interest that I do earn with inside of that policy contract as well. So it kind of got me thinking, all right? I just received my property tax bill in the mail, and I bet a lot of y'all are receiving that this month. And specifically for my new property here on Daytona Beach Shores, this tax bill is costing me $10,693.31. My other place, just 15 minutes down the road that I was just at today. I was meeting up with a property management company. I'm thinking I might rent her out, to be quite honest with you. So that's a whole other realm that I'm getting into. So I will keep y'all posted on my experiences and what I am learning along this journey. But I just got that property tax bill in the mail too for the other one. It's like a little under $1,500. So $1,500 all the way up to $10,000, almost $700. I'm like, oh my gosh. So this is why I do store and keep capital inside of my policies, because when tax bills have to be paid, I got to go and pay the IRS government. I need to, God forbid, let's say that Daisy, she eats something, then she starts choking and she has some, stuff going on internally with her. And then let's say I get hit with like a $5,000 vet bill. We need to have some capital stored up somewhere for the rainy days. I think a lot of y'all saw that during the COVID times, when people did not have the money stored up and then they were laid off for months and months, sometimes 1 to 2 years. I think people are now understanding that, hey, I need to have some emergency money sitting somewhere. And I don't think there's a better place than to store it within inside the policies. So here's kind of what I do. I keep 3 months of my overhead expenses in my conventional bank account down at Wells Fargo, US Bank. Those are just the banks that I bank with. And then I keep 3 months of my overhead inside of my policies. And that's just the money that I do not touch. That is my rainy day funds, because in the event something were to happen, I got 6 months of overhead expenses covered there. Hey Money Multipliers, pardon the interruption. This is just a reminder that if it's been a while and you haven't seen our 90-minute presentation, I would pause the episode here, go to themoneymultiplier.com/presentation and start there. That's a good place to start, just to understand the foundation level of what is IBC, why are we practicing this, how we're doing it. So go see over there. And also, if it's been a while and you haven't reread Nelson Nash's book, Becoming Your Own Banker, go and reread it. All right, sorry the interruption. Let's get back to the episode. So I got this one, I don't want to call it a problem, but I got a problem here. I got my property tax bill that I got to go and pay. But then also, I can do that with my policies, and I'm going to be walking through it here today. But I also got to recognize I do have this death benefit that's on the policy as well. Because what got me thinking about this is we have somebody up at the insurance companies who we love dearly. They help us a lot within the business. And unfortunately, his wife passed away. She had cancer for about a year or two, and it just got really bad there towards the end. And it was her time to go home to Jesus. And so she passed, and this gentleman, he wrote all of us an email. And I'm not going to read the whole entire email, but there were just some things I really wanted to point out that I think would be good for the community to hear as well. He starts off by saying, in the middle of his email, he goes, "But my family and I have mourned her well, felt incredible love in return, and are resolved to go on as we must, living fully like she did right until the end." Which kind of had me thinking too. I do not want a boring funeral. I want to have a freaking party. I want people to get hammered. I want people to sing karaoke at the top of their lungs. I want people just to have a good time and dance like there's no effing tomorrow at my funeral. That is how you should be mourning me. I want y'all to go out with a big bang. Hell, have a piñata with my face on it and have all of the candy in the world just sprawl out from it as you're hitting my face at my funeral, okay? That's the type of funeral I want. But you should, live life to the fullest. Tomorrow is never promised. Tomorrow is never guaranteed. And yeah, there's death benefit on the policies. He continues on. The crazy thing to me is that everything about her family pointed to longevity. But what do we as life insurance pros have to plan for? The unexpected. So, what do all of our clients and prospects really need? A wake-up call. My question to you today is, what made your clients policy owners during this month? What did you actually say? And it had me thinking, as being an educator and a producer within the life insurance space, it kind of had me thinking, what did I say? Because over here at the Money Multiplier, I mean, we are getting in right around 100 new clients a week. And it had me kind of thinking about the conversations that myself and the other money mentors on the team are having with people. And the one thing that always comes to my mind is, I think, if not IBC, then what? If not the infinite banking concept, then what? What are the other options? And I talk about this all the time on the show. I can put it in the bank. I can leave it in my house. I can leave it with a financial advisor, put it into a 401k, put it in the stock market, turn it into gold. There's so many things that I can do with the money, but this is why when it comes to protecting the fiat paper currency money, I don't think there's a better place to warehouse, store, and protect it than inside of the whole life insurance contract. Because reminder, what does Nelson Nash say in his book, Becoming Your Own Banker? He says whole life insurance should have never been called whole life insurance, because really what the insurance companies produced and created was a personal monetary banking system with a death benefit that's just thrown in on the side. That's really all that it is. So if not IBC, then what? But we do got to understand that it takes time to capitalize. And I think that's one thing that I could be doing a better job of, and the Money Multiplier team and a lot of other IBC practitioners, is that it takes time to capitalize and build up the policy. You are starting a business from scratch. I mean, think about it. These banks that are out there, Bank of America, Truist, TD Bank, right? You get the gist. All of those banks had to go through the time and the labor and the resources to build up the capitalization, get their credentials, go through all of the legal process, get all of these stamps of approval to then have that established branch bank that's sitting there on the corner of I-4 and I-95. Just kidding, I don't know. But right, they had to go through all of that startup period to get to that point where they can start accepting depositors and customers and then lending out to depositors and the customers. And so it's going to take time to build up your privatized banking system. And this is a marathon. It's a lifestyle change. It's a long-term process and marriage that you're really walking into with yourself, with the insurance company, and then having the self-discipline to carry on the behavior of you being an honest banker with yourself. You know, I say it all the time. The only person and thing that can screw this stuff up is you and how you use your policy. If you just stick to the basics of pay my premium, pay it on time, pay my loan interest, and I don't skip a beat in doing any of that, you will be fine. And stay in tune with what's going on in your money life. I mean, I know how some of y'all behave and how some of y'all act. What's going to happen coming around in January is you guys are going to get back on the horse. You're going to be writing everything down, being very disciplined, having an organized schedule. And then January 20th is going to hit. And then it's like, oh, well, that's all done. That was good for the first few weeks, but now I'm just going to go back to my normal habits. You can't create a life that's different than the one that you're living now if you're not willing to break the bad habits and patterns that you do have right now. You're going to have to make some changes. It's going to be a little uncomfortable, but then once you hit that point, it's just going to be smooth sailing from then. So just know that you have us here. You have a team. I'm here to back you up, and I want to set you off on that good path. And I just want to share with y'all, hey, this is what I'm doing in my own life and what's working for me. And one of the things that I do every year with my policies is I pay my property tax bill. So I want to walk y'all through the reason, number one, that I use my policy to pay the property tax bill, but also the process of how I pay it back to myself. Because yes, I am doing infinite banking, but I got to be a good infinite banker. And when I'm a banker, I pay myself back, and I pay myself back with interest. So this right here, this is an example of a 5-year-old policy that I have. And before I even get into this, actually, the whole reason I wanted to get into that whole spiel of, the problem that IBC really solves is that we do not save our capital. We're severely undercapitalized. There was a comment that Mike Ross left me on episode 121 of, hey, you're showing me this whole concept of using the F word, financing. We finance every single purchase that we buy. We either take money from the bank, we take out a bank loan, we pay cash for it, or I have to lease an object, right? But why would I use my policy instead of going out there and taking out a bank loan from someplace or someone? And he says, well, hey, these two scenarios can't be considered. It's like apples and oranges, because this one example is the gentleman who has the money, and this other example is the one who doesn't have the money, and so that's why they have to go out and borrow money from the bank. But we're missing the one key ingredient of rule number 1, pay yourself first, okay? I don't get into the other rules of using the policy until after we get into rule number 1 of pay yourself first. And if you ever forget the 3 rules, here's what they are. Pay yourself first, pay yourself back with interest, recycle and recapture the money. So paying myself first means my premiums in my policy, because I have to make my deposits somewhere. So instead of me being a consumer or a slave to somebody else and holding my money in somebody else's bank, I'm making my deposits into my bank now. So rule number 1, I'm paying myself first, and then from there, I'm conducting the banking business in my life. So I agree with you, Mike Ross, for that comment. However, we're missing the key human behavior that we have to overcome if we want to be totally financially independent. Is we got to capitalize somewhere, and we should be paying ourselves first. And in my humble opinion, it should be the monies that are going inside the policy. You don't have to agree with me, but that's just my personal opinion. So after I have capitalized my policy, and this is actually my first ever policy that I started. This is a 6-year-old policy. And this is actually the one that I talk a lot about, that my first ever purchase was my $2,500 MacBook computer. This is the policy. So you'll see right here that I have a cash value that's available to me as of November 4th, 2024. So this is earlier in the month when this episode gets released. But I have a cash value of $40,476. So that's what I can take as a loan out of my policy, and the insurance company is going to charge me a 5.84% interest to take out this money. So here's what I did. Because my tax bill that I got to pay is $10,693.31. So I said, okay, let's just round it out. Let's call it $10,700. So what I did is I went online, because there's 2 ways how I like to request my loans. I'll go online, or I'll just call up the insurance company over the phone. Most of the times I call them up, but this time, I don't know, I guess I wasn't feeling chatty. So I went online and I processed my loan request. All that it asked me for was my name, my social security number, my address, and then the policy number. Then from there, they asked me if I was the owner, which I am. And then they asked me, well, how much do you want? Is there a specific amount, or do you want the max that's available? In this one, I put in the specific amount of $10,700. They then asked me, do I want that to be EFT'd to my bank account, or do I want a paper check? I selected the option of the EFT. From there, they went in. I had to do some confirmation of my identity. They asked me some security questions, and then I electronically signed off on the form, and then it was submitted directly to the insurance company. So now I wait. This was about, was it yesterday? Is yesterday or the day before when I requested this? But I will keep you posted on when it actually hits my bank account. With my experiences of my policies over these years, when I do like an EFT to my bank for the loan request, it's taken no longer than 3 to 7 business days for it to hit my bank account. And I see this probably happening in the next, because if today is Thursday, it's probably not tomorrow, probably early next week is when I'll receive the loan money. So when I receive this loan money, I'm going to write a check to the state, pay this property tax bill, and now I'm going to pay myself back and I'm going to charge myself interest because I got to play honest banker with myself. Because reminder, the number one reason that businesses fail is because of theft. Bankers in the banking business, some of the main reasons that these banks go bankrupt and then they have to have the Fed bail them out is because their non-performing loans are coming from the head executives of that bank. So I got to make sure this is the most important part, to pay myself back and charge myself interest. So then what I did is I like to go to a website called bankrate.com, and I look up their loan calculator. And so when I went on there, I typed in my loan amount of the $10,700, and I want to pay this back in 12 months or 1 year. I could extend it out longer if I wanted to, because remember, when I went in and did that loan request, the insurance company never asked me what I'm using the money for, when I'm going to pay it back. I'm not required to enroll in a repayment plan or do anything like that. So me, because I know in 12 months another property tax bill is going to hit me, I'm going to be prepared to have monies in my policy to go and do this again. So when I run the calculations, $10,700 for 12 months, it then asks me for the interest rate. I do an interest rate of 10%. When Hannah Kessler borrows from the privatized bank of Hannah Kessler, or sometimes I like to call it the kitty cat corner. That's what I call my house over here, this kitty cat corner. If you log onto my Wi-Fi, it's kitty cat corner. So my bank name is going to be kitty cat corner. So when I make loan repayments to kitty cat corner, I charge myself 10% interest. That's just what I do. More interest I charge myself, it's going to be more money back inside my pockets. When I did that calculation, the loan calculator came out to a monthly payment of $940.70. $940.70. So what this is telling me, if I get in here to the amortized, excuse me, Hannah, words are hard, amortized schedule, it's showing me that I'm paying $588 of interest to myself. That's how much extra I'm going to be putting back. So then from the amortized schedule, you can see how much I'm paying back each month, what's going to interest payments, and what's going back as my principal back to myself. And this is important. We need to understand the amortized schedule. I think a lot of people are aware now, especially if you're tuning into this podcast, you are very aware that no, it's not the interest rate that kills us. It's our volume of interest that we're sending out to the third-party people. And if I can just recapture that volume of interest back to myself and my own banking system, I mean, I'm outbeating everybody in the game. I'm creating what Nelson likes to call the perpetual tailwind in my financial life. So I want to show you how to do this. I'm really going to write this all out. But before I get into this short little demo, and if you're listening to me, maybe it's a good time to switch over to the YouTube channel so you can see this whiteboarded out. But some of y'all who have been around the campfire for a little bit, you may be asking yourself, well, Hannah, so you're taking out a loan of $10,700 and you're going to put back the principal of the $10,700 in 12 months, but you're also going to be putting back an extra $588 of extra interest payments. So how is that going inside of the policy? And I'll tell you, that extra $588, that's going to go in as extra paid up addition premium into my policy. But now you may be thinking to yourself, but Hannah, what if my policy won't be able to hold that extra PUA premium? What if it causes it to mech? Here's what I did. When I requested my loan out of the policy, I wrote an email into the insurance company. And if you're a Money Multiplier member, reach out to your implementation specialist and they'll show you how to do this. But I wrote an email to the insurance company and I said, hey, how much extra PUA premium can I put into this policy and not hit my mech limits? They came back. They said, as of November 2024, and let me add too, they actually came back within 48 hours. It was very, very quick. As of November 2024, the above policy can accept additional PUA rider premiums up to $300.96 without violating contract guidelines or creating a modified endowment contract. Well, Hannah, I'm paying back $588 that should be going to extra PUA premium, but I can only fit in $300.96. So how's that going to work? Where is that extra $288 going to go? This is where the power of the segregated checking account comes into play. So I'll map this out right now for y'all. But this is why, as we start to expand our banking system, play Honest Banker, we are going to start to notice more capital that's lying around. And there's ways that you can get this extra capital into policies. Number one, let's just make believe I was doing a monthly premium. I can always pay up my premiums, and that's ways that I can get more monies flowed through the one existing policy. But in this instance, this is an already annual premium policy. My premium doesn't come due until 2 months in January. So I don't have any extra wiggle room to put this $200 into this policy right now. So what I do is I keep it stored within my segregated checking account. And as that continues to build up, I'm going to use some of that money. I can pay my loan interest, but also that's what I'm going to use as extra cash flow to start putting towards more policy premiums as well. So I use my segregated checking account for number one, pay myself first. So when I get money that comes in, I take a sliver of it and I move it to that segregated account, pay myself first, being disciplined with the money because I don't want to be a victim to being undercapitalized. But then also it's a place that I'm able to store the extra interest that I want to charge myself there because I'm playing Honest Banker. And then from there, that's where I can start more policies and branch out from that. So let's get into this little drawing. I want y'all to see visually how this is all panning out. For my folks who are listening auditory right now, it might be a good idea to flip over to the YouTube so you can see this visually drawn out because I want y'all to really get the flow of the money that happens here. So what happens first is I make my premium deposits into the policy. My premium deposits, for my folks who don't know where to start, remember, policy is just our glorified savings vehicle. So where a good place to start is number one, assessing the problem. The problem basically being your budgeting and understanding where your money is going, income minus your expenses, the leftover monies. That should be the dollars that start to flow through the policy. So that's a good place to start in identifying what that good, comfortable premium is to do in your policy. This first policy that I did, $400 a month. That's where I started. That was my good, comfortable premium being a waitress at Cracker Barrel back at that time. So my premium deposits go into that policy. And then I had the cash value of about $40,000 and some change, but I only needed $10,700 of it. So what I did is I took out a loan of the $10,700. That $10,700 went into my segregated checking account. The segregated checking account is just a checking account that I have at my local bank, just where I like to do my business with. And the reason that I don't commingle it with my main checking account is because loan money is tax-free to me. And I just like to keep this separate because come around tax time, trust me, your accountant and your CPA will thank you for this. If you keep them separate, it's a lot easy to identify what's taxable income and what's not. So the $10,700 goes into my segregated account. From that segregated account, that's how now I will go pay my not IRS tax bill, my property tax bill. So now it's with the property tax people. I paid them off. Now they're good. What I'm going to do now is just save back up. Saving back up for next year because I know I'm going to get hit with another property tax bill. So when I went to bank rate and I wanted to charge myself 10% interest and having it outstanding for the 12 months, it told me my monthly payment should be $9.40 every single month. So that $9.40, that is going to flow back to my segregated checking account. And then from my segregated checking account back towards my policy. This $940.70, this is being paid through my active income, my passive income, doesn't matter what type of income, but I'm making sure that I'm adding it as a obligation that I need to pay this back to my policy every single month. So that's how that goes back in. Now, for my people who are experienced with this, how am I tracking to know when I'm not going to mech or overflow my policy? Well, every month I'm going in and I'm paying back those loan repayments. I have access to my online portal with the insurance company. So I can see and go in there how much I filled up of that loan repayment of the principal amount. And then I know I have an additional $300 of more monies I can get inside of there. I pay that all the way up, filling it as much up as I can. And then that extra $288 that of the extra interest that I couldn't fit in as extra PUA premium or loan repayment, that's what's going to stay here in the segregated checking account. Because then from the segregated checking account, I'm going to assess, okay, are there other policies that I have that I could pay back into? That's what I'm going to do. I got a Lafayette Life policy that has some outstanding loans. I'll take that $288 and just go store it back over there. Or maybe all of my policies are filled up, no outstanding loans, all of my extra PUA premiums are paid back. That's when I know that I'm ready to start an additional policy. I hope that was helpful for you folks just to see it visually mapped out as well. I know I'm explaining it all the time auditory, and I know that a lot of y'all have different learning styles and how you receive information best, but just seeing it mapped out like that, hopefully it made it easier, right? I mean, this stuff is not hard, right? This stuff is not rocket science, but it's just different and unconventional to how we've been taught to handle money. And we got to overcome some of the noise and the backlash that we do hear out there. I call it policy PTSD. I mean, I meet a lot of you people who have had old whole life policies. You cash them out because you didn't understand the benefits of what you had and nobody explained it to you this way of what you can use and do with the equity and the cash value that's within inside of that policy. So just a lot of reasons of why you should be owning whole life. I am just a big advocate of it just because of how it's totally transformed my family's financial life, our financial family's legacy and generational wealth to come with this. I mean, I'm just very, very excited. There's a lot of things in the works that I want to do as I evolve in this lifetime, charitable organizations and different things that I want to actively get involved with. And the number one resource that a lot of people need to grow, and no matter what business, charitable event, or help that somebody needs at the time, a lot of the pain that's being caused is really the money pain. And it's just asking ourselves, well, hey, if I can solve this money problem that I have, what are the endless opportunities and things that I can do for people in my family and within the community? And so that's what I want to help y'all with, is mastering the money game, understanding your cash flow, and then keep creating more cash flow so then we can go and fill other people's cups up with it. So thank you, y'all, for being here on another episode. I am very honored and thankful that y'all are here. I know next week is Thanksgiving, and I just want to express all of my gratitude. I mean, I would not be here doing the things that I'm doing if it wasn't for your support, the community, and believing in each other and in me, the Money Multiplier team, and just putting the honor and the loyalty here with us. So thank you. I'm grateful for all of y'all. And if I don't catch you next week, happy Thanksgiving, everybody. I'll see you next time. Bye, y'all.